Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, March 21, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Over the last couple of trading sessions, we've been talking about the importance of and leading up to the FOMC interest rate announcement. Now, the FOMC, or the Federal Open Market Committee, actually did raise interest rates 0.25%, which was expected by the market. So there was no surprises. Interestingly enough, leading up into the announcement and right after the announcement, the market was up. The market was up slightly leading up into, and then once the announcement came, the market shot up, and then it turned around and went down the other way, finishing near the lows of the day. Now, whether or not this is significant is somewhat of an open question. We've seen this book many times before. When we go over to an intraday chart, you'll see what happened. Here's the interest rate announcement. The market shot up, and then the market turned around, went down the other direction, finishing near the lows of the day. Now, in the big scheme of things, it's not that big of a deal. The S&P 500 was down about 5 points today. That's not a big deal one way or the other. The Dow was off 44 points, and the NASDAQ Composite was off 19 points. These in and of themselves are not big moves for the market. What will be important is how the market reacts in the coming day or two. So on one hand, it could just be market gyrations in and around the announcement, the anticipation of the announcement. There were traders and investors jockeying for position, and the market whips around, and that's not that untypical or uncommon for a Fed Day announcement. What will be interesting is how the market reacts tomorrow and Friday and beyond. So let's talk about where we are, and we'll talk about the downside, and we'll talk about the upside. As you can see today, the market got stopped just short of the 20-period moving average. When we shot up, you can see here the daily 20-period moving average, which came in today at 273.41. That's the red trend line. Today's high was just short of that. Today's high happened to be 273.27. So we came up just short of the 20-period moving average. The market turned around and finished near the lows of the day. We've also been talking about the fact that the moving averages above us will be and are some overhead resistance. And below us, you can see we have the 100-period moving average. So here are the important numbers, and I've already got the lines drawn out on the screen. 267.61, that's going to be an extremely important number. We may or may not get stopped if we continue lower by the 100-period moving average. We've already visited the 100-period moving average a couple of trading days ago, so if we did come down back to the 100-period moving average, I wouldn't expect that to be as good of a support area as it was the other day, which was on Monday. So beneath that, we have the 267.61. Where does that come from? It comes from this breakup candle, which has a low of 267.61. That will be if the 100-period moving average does not hold. If we do continue lower, that will be another area of support. It will also be an important area of support. And again, these are some of the things that are discussed in my course at LazyEMiniTrader.com. You can see here, there's a lot of chart consolidation in and around this 267.61 area. 267.50, 267.70, in and around that area. This is called chart vibration. This is consolidation that was made on the chart before we made a move higher and broke up to the upside. Markets like to come back and revisit these consolidation areas. Now, we've already been down to this consolidation area. However, that doesn't mean that the chart doesn't think that that area is important. Once again, that area is important. The chart is telling us that that area is important. I would expect it to be at minimum of intraday support one more time. Now, on the downside, if we did continue down farther, the next area of support would likely be the 264.82 area. That's this pivot low that comes from the 2nd of March. That area is important. If we did not hold that area for some reason, then there is much more downside coming, in my opinion, in this market. Now, all this is important if, in fact, the turnaround today and finishing near the lows was important and was indicative of what's to come in the coming day or two. Now, there's also the other side of that, which could be the fake out side. Now, if in fact it was a fake out and tomorrow and Friday we turn around, the market goes higher, where would we expect the market to go? Well, there's a pretty obvious resistance point in the market, and it's one that we've talked about before. And this pivot high right up here that comes in right around 274.5, actually 274.40 is the number. That's an area that you will find a tremendous amount of resistance in this market. Number one, it coincides with the 50-period moving average. That's your blue trend line. Number two, it coincides with the high of this breakdown candle, which comes in exactly at 274.40. So if the market has a rally day on Thursday that goes into Friday, obviously it could happen all in one day. If we get up to that level, that will be an area where the market would have a relatively difficult time getting through. If we begin closing daily above that level at 274.40, that will be very bullish for the market, and there will be more upside coming. That will be an important area that will provide intraday resistance without a shadow of a doubt as far as I'm concerned. That's if the market turns around and if today's sell-off towards the end of the day was just a fake out, and if we wake up tomorrow on Thursday, the market turns around, that will be, in my opinion, where the upside is likely limited to, but that's a big move from where we are, but that will be a very, very strong resistance point, 274.40. We'll put that line on the chart, we'll make it in red, and if we get above on a daily closing basis, meaning we have to close above there at the end of the day, 274.40, that will be bullish for the market. That will not be an easy thing for the market to do. And by the way, it's not only the top of this breakdown candle that makes that area an extremely good resistance point for the market. There's another reason which is taught explicitly in the course at lazyeMinitrader.com. It's a mathematical reason, and when you have multiple reasons that all point to the same number, that makes resistance and or support areas that much more important to the market. In this particular case, we have two very, very strong and important reasons why that area up at 274.40 is extremely important. The market is not going to just walk through that area. That's if we get upside, if this was just a fake out on the downside following the Fed announcement. And by the way, flipping it back around one more time on the downside, I've got one more line that's important. 262.93 is the math I come up with. The 262.93 is an area that if those first two support areas do not hold, that's where the market is likely to find a very strong level of support and really what is the last line of defense before we come down to the 200-period moving average and potentially all the way down to double bottom. These things don't tend to happen in one day. I'm just giving you the numbers that we have to watch out for. I will keep these numbers on the chart. If this market does continue down, we need to watch out for these three levels on the downside as support. 267.61, 264.82, 262.93. These are important areas. Going over to the IWM, my favorite market leading indicator, both on the up and the downside, what we have here is a nice up day. We were up about 0.7% in the IWM today. It was up about $1, and that's showing signs of bullish behavior. So if there's any indication of the IWM continuing to be a market leading indicator, this is telling us that there's limited downside coming in this market. We're not seeing the IWM sell off. We're not seeing the IWM leading the market on the downside. The IWM remains above all the moving averages. The IWM IWM remains in a very bullish position, and technically speaking, there's nothing wrong with this market. Now, that doesn't mean we can't have a down day, and it doesn't mean the market can't sell off. I'm just looking at the piece parts independent from one another and telling you that as my favorite market leading indicator, the IWM is not making me nervous. It's not telling me that the market is going down. The IWM is showing signs of bullish behavior. We had an up move. We had a bullish wedge pattern, a pullback pattern right into the moving averages. And here we are trading higher. Generally speaking, this pattern will continue higher and complete above the high of the A leg that's right up here. That's under normal market conditions. The markets in and around the Fed announcements tend to get disjointed from time to time. Today may have been one of those things, but I wanted to give you the downside potential if the market decides to sell, and also the upside if the market begins to rally tomorrow and or Friday. IWM not giving any indications of downside behavior whatsoever. Looking over at the transports, you can see the transports were down today, and we do have this bearish pattern that's still intact. So we have this down move, and this is a bearish wedge pattern. We made an attempt at the highs today when the Fed made their announcement, and we did sell off from those levels. Until and unless we can get above and close above this level right here that comes in at 10,799 spot 56. Until we can get above and close above that level, then this market is still going to be contained from a bearish perspective. This is a micro, I'll call it, bearish pattern inside of a macro bullish pattern, right? So we have the up move, and this is really just a pullback inside of an up move from a longer term perspective. We're consolidating underneath the 50-period moving average, supposedly under normal conditions, building energy to make another move higher. However, we do have on the shorter time frame, shorter term perspective, this bearish pattern that will generally play out to the downside. So there's some conflicting information found on the charts of the transports. Looking at the hourly chart of the transports, I think this is a good opportunity just to take a quick lesson in the patterns that exist on the chart. So we had an up move, and then we have sideways consolidation in the transports. We had another up move, so this pattern was essentially complete. It did exactly what it was supposed to do. However, it rolled over, and now we've closed back below the original up candle, okay, that made the bullish pattern or completed the bullish pattern. Now we've closed back below that. So is that a failure? On the hourly chart, we're below the 50 and the 20-period moving average. Does that mean that we're going to come down farther? It may. It may mean we want to come back down and revisit this double bottom area right around the 100-period moving average. It's something to watch out for if we do get a sell in the markets, including the transports tomorrow and or Friday. On the hourly chart, these are the areas you want to note. If we close below on an hourly basis, these areas, then we have a gap fill down here, and the market will want to come down and fill that gap. So these are areas from an intraday and hourly perspective that we want to watch out for. Again, these are all things that are discussed in detail on how to read the charts in my course at Lazy E-mini Trader. Switching over to the gold market, gold had a nice rally today, was up over $10, and like all the markets do, in and around the Fed announcement, all the markets tend to move. When one market moves, they all move. Stocks moved, precious metals moved, interest rates moved, currencies moved. We talked about that yesterday, and here we are in the gold market, and you can see first we were consolidating over the 100-period moving average. And we said that under normal conditions, the longer we consolidate over this area, the more likely we are it to go down farther below the 100-period moving average, not to look for the 200 to be much support at all. And we said our bookends were on the downside. If we got below this area on a closing basis, that was very bearish. And if we got above this area on a closing basis, that would turn the market bullish. Well, look what happened today. After the Fed announcement, gold spiked up. And gold spiked up above the 50-period moving average, made an attempt at that high up here, the high from the 7th of March, and it failed, and we traded back down, and we're now back below the 20-period moving average. Doesn't mean we can get a picture-perfect read on the gold market. There's really nothing has changed. There's really no change in what the markets have been doing and the pattern that has been developing, or lack of a pattern that's been developing in the gold market over the last several days. We still remain in the middle of a range. Here's the bottom end of the range. Here's a top end of the range, and you can extend it to all the way up here as well. Either way, any way you want to look at it, we're in the middle of a range. In the middle of a range, things are less clear, and when things are not as clear as we need them to be in order to deploy capital to make a trade, then we do nothing. And right now, the gold market isn't really in that much of a different position than it was yesterday. It looked like it wanted to rally. It began to rally. It looked like it was going to go higher, and then it failed. What can we derive out of that information? As long as we stay beneath the 20-period moving average, nothing has changed, and we're in the same position we were yesterday. Getting above 1342 and closing above that area, that turns a different picture around. That turns the gold market bullish. Until and unless that happens, the gold market should remain under somewhat of pressure. Crude oil, check it out. Crude oil is rallying. Obviously, yesterday we talked about the fact, and we have been talking about for quite a while, the $64 number. That was very important. Yesterday we rallied up to that level, came 2 pennies short. The high yesterday was $63.98. Today we rallied right up through that area, right up into the next level of resistance, $65.23. The market closed on the day at $65.17, just a stone's throw away from that important number of $65.23. And guess what? As the the electronic session trading opens for Thursday's session, we're now above that level. This is bullish for the crude oil market, and if in fact it remains bullish and we can get above these highs up here, then we bring back into the fold the $73 to $74 area that we've been talking about for quite some time. It's not going to happen all at once, but certainly comes back into the equation. Looking at the weekly chart, the important level, and here's a breakdown candle. The high of that breakdown candle is $65.29. Friday's close, the weekly close, is going to be extremely, extremely important depending on where we close in the crude oil market. If we close above that area, very bullish. If we don't close above that area, it's not necessarily bearish because we can certainly do it in the following week, but that's the area that we have to watch for based on the Friday close. That's a weekly chart. That's what I'm watching for Friday's close. And there it is. We'll leave it on the chart, $65.29, important weekly closing price. That's what we're watching based on Friday's close. And with that, folks, it's everything I wanted to and intended to discuss tonight, so we're going to give it a wrap there. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.